A favorite tactic of the financial industry is to point to the historic track record of stocks and use that as justification for why you should buy them and hold them and make them the majority portion of your portfolio. Stock advertisements are emphatic about the record of stocks for wealth building and inflation protection, yet all mutual fund prospectuses have the disclaimer, "Past performance is no guarantee of future results." So, if there is no guarantee, then why do investment advisors rely so heavily upon the historical record? My best guess is that it is a convenient way to attract your money to their product. Many people, other than yourself, benefit from your purchase of stocks. The broker and mutual fund manager benefit from the commissions. Corporate executives benefit because it increases the value of their stock options. And Uncle Sam benefits from the taxes. And what do the financial advisors say about gold? Well, they generally state that it is a risky asset and has a terrible track record. Sure, if you started your investing career in 1980 at the peak in the market, you would have had a disappointing first decade. Financial experts love to point to this as a reason not to hold gold. At the same time, they overlook that if you were a gold investor in the 1970s, you would have fared much better than the average stock investor. So why do the financial experts hate gold so much? Does it really have such a bad performance record? Or is it that there is just no easy way to skim money from the gold buyer who just buys it and socks it away? Let's take a look at the past 45 years and see if we can figure it out. While we're at it, let's take a look at bonds, which investment experts tell you should hold for the purposes of safety. Let's start our assessment of investment performance by taking a look at what's happened to the cost of living over 45 years. After all, the whole point of investing is to grow your purchasing power, or at least preserve it. If you can't find an investment vehicle that at least comes close to matching the increasing cost of living, then there's probably no reason to save at all. My favorite proxy for inflation is oil. Energy, especially oil, is a major component of everything that we buy. The federal government likes to exclude oil from their inflation statistics because they claim that it is too cyclic and too volatile. Over long enough periods of time, though, that volatility is irrelevant, and so, for our purposes, we can use it. Besides, by using something as pure as oil, our measure that we use can sidestep the obvious conflict of interest involved in the government providing inflation statistics. After all, it is in their best interest to downplay cost of living increases. They do this by using hedonic adjustments, geometric weighting, and substitution in their indices. In the end, it leads to an inflation measure that is several percentage points per year below what you and I as consumers experience. So that said, let's use oil. In 1968, oil was $3.18 per barrel. Over 45 years, it increased 32-fold to $102 per barrel. This works out to an annual increase in price of 7.9% per year. Is it that the oil is becoming more valuable? Well, maybe. But it's more likely that this is the true rate of decline in the purchasing power of the dollar. The key takeaway is this: if you defer consumption and want to save, you better pick something that after taxes will increase in price by 7.9% per year or more. Okay, so now let's take a look at the past 45 years for gold. In 1968, it was $35 per ounce. By September of 2013, it was trading for $1,326 per ounce. This is a 38-fold increase in price, or 8.3% per year. So in terms of purchasing power, gold has increased in value relative to oil by about 0.5% per year. But what about taxes, you say? Okay, that's a fair point, so let's consider it. Taxes are very dependent upon where you live, so this topic will be US-centric. If you live elsewhere, you'll need to adjust accordingly. Bullion is taxed as a collectible, and the taxes are only due in the year in which you sell the asset. For certain types of bullion, namely 4/9's fine, because it can be used to settle a futures contract, a broker will notify the IRS upon the sale. Other items, such as gold eagle coins, are exempt from broker reporting requirements. In the eyes of the IRS, you are still responsible for reporting any nominal gains and paying the resulting tax. It is solely your responsibility to do so. Assuming you held the gold for the full 45 years and paid taxes on the nominal gain, which was mostly inflation, your after-tax rate of return would be reduced to 7.5% per year. The taxes took a big bite, but you still came very close to preserving your purchasing power in terms of oil. So now let's take a look at 45 years of stock prices. The S&P 500 is generally the standard measure of stock performance in the States. In 1968, the S&P was 92.56. Over 45 years, the price increased by 18.3-fold to 1692. This is a 6.6% rate of increase in stock price. Of course, nobody can own a portfolio of stocks without going through a broker. Most people who choose to own an index do so through a mutual fund. If we take into account the impact of management fees and taxes paid on portfolio turnover, it knocks about half a percentage point per year off of the gain. This brings the yearly rate of return down to about 6.1%, which is less than the rate of increase in both oil and gold. But what about dividends? The reason for owning stocks, after all, is to share in company profits. So those dividend payouts have to be considered. Okay, let's do that. In 1968, the dividend yield was 2.9%. Of course, if we want to be forward-looking, we'd have to admit that you can't have that 2.9% yield now. The yield now is 2%. You'll be taxed each year on these dividends, which will reduce the take-home yield to 1.3%. So, if we had to project a reasonable nominal return for the future, it would be the historic rate of appreciation of price after fees and taxes of 6.1% per year, plus the after-tax dividend return of 1.3% per year, for a total of 7.4% per year. This is about half a percentage point per year less than the historic rate of increase in the cost of living as measured in oil. Now let's take a look at Treasury bonds. In 1968, the yield on the 10-year Treasury was 5.5%. In 1980, it was 11%. What's interesting is that even if you bought when the yields were as high as 11%, after you paid the taxes on the interest, you would have just barely kept up with the annual price increase of oil over the past 45 years. Of course, you can't buy that yield now. Currently, the 10-year Treasury is yielding 2.6%. After you pay the federal taxes on the interest, you'll nominally be making 1.9%. This is a full 6% per year below the historic rate of inflation as measured in oil. When the financial experts tell you to buy bonds for safety, it's not clear to me how they can avoid malfeasance lawsuits. So now let's wrap it up with an overview. You have a choice of which investment vehicle to purchase in order to preserve your purchasing power. I've used 45 years of history to compare them and project what the price increases might look like if passed as prologue. Of course, I have to add the typical disclaimer to this. Past performance is no guarantee of future results. Just keep in mind that unlike the financial experts, I have nothing to gain by providing you with this analysis.